I don't think gold's going to go off to the races until the next printing round starts. It could stop. We could stop the decline here, and we could head steadily higher on a stair-step way, like we did in the end of the last bull market. I think that's what's going to happen. But again, like if you've been buying every month and you've been buying, a certain dollar amount every month for the past, year, does it really make a difference if you got in at 2,800 and then you buy another tranche at 2,550 and then next month it's 2,700? Like, who cares? We've got to stop looking at the dollar price. The dollar price doesn't really matter with gold. It matters with Bitcoin. If Bitcoin doesn't keep going higher, I think people lose interest, but nobody's ever going to lose interest in gold. It doesn't make any sense.
Gold has long been viewed as a safe haven. Bloomberg reported that a recent Deutsche Bank report highlighted its impressive performance as the best-performing mainstream asset in the first 25 years of this millennium. Although the gold price is very much in a strong uptrend, for speculators, the main game in terms of price target is the level of $3,000 per ounce. Their current belief is that the odds are becoming weaker for the gold price to touch that level by the end of this year as fundamentals have shifted. Financial expert Rafi Farber mentions gold's recent correction as a routine pullback, emphasizing its insignificance in long-term trends. Comparing it to the 2009 to 2011 bull run, he advises against overreacting to such dips. Various market analysts, including Rafi Farber, question Bitcoin's viability as money, contrasting its reliance on price growth with gold's 5,000-year stability. Despite Bitcoin's popularity, he remains skeptical of its long-term role. Currently, central banks hold around 20% of the world's gold reserves, reflecting their confidence in its enduring value and utility in financial systems. In contrast, their holdings of Bitcoin account for only about 2% of the world's Bitcoin supply. This discrepancy highlights gold's entrenched position in global finance and Bitcoin's relatively speculative and developing role. On a technical basis, Rafi predicts gold will outperform assets like Bitcoin during financial crises, citing Bitcoin's sharp decline in gold terms in 2022. He might consider Bitcoin a gold derivative if it holds value in future crises, but this remains doubtful. Now we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think it's a pretty good buying opportunity. I looked at the low versus the high. I think it came out 9.3%. 9.3% is a perfectly normal correction. You don't even have to sweat about it. I mean, these things happened during the 2009 to 2011 major bull run at the end of the gold bull market in those 2 years. And, we barely see those on a map anymore. So what are we sweating about a 9.3% correction? It's a little bit more frustrating when Bitcoin reaches like 95,000 or whatever it's at. And that's great. I mean, I hope Bitcoin is money. I don't think it is. And I'm happy if you're a liberty-minded person who has a lot of money now. That's great. Just be careful with it and lock some of it away into an asset that has 5,000 years of history instead of just like 15. That's what I would do. So is this the bottom? We don't know. I don't think gold's going to go off to the races until the next printing round starts. It could stop. We could stop the decline here, and we could head steadily higher on a stair-step way, like we did in the end of the last bull market. I think that's what's going to happen. But again, like if you've been buying every month and you've been buying a certain dollar amount every month for the past year, does it really make a difference if you got in at 2,800 and then you buy another tranche at 2,550 and then next month it's 2,700? Like, who cares? We've got to stop looking at the dollar price. The dollar price doesn't really matter with gold. It matters with Bitcoin. If Bitcoin doesn't keep going higher, I think people lose interest, but nobody's ever going to lose interest in gold. It doesn't make any sense. I said, when am I going to be wrong about Bitcoin? When we see the next financial crisis, the next monetary crunch in the bond market collapsing, and what I said about the repos and running out of dollars and the money markets freezing up just like it did in 2020 and 2008. If that happens again, it's going to happen again. When that happens again, if Bitcoin can maintain its price in gold terms, not in dollar terms, I don't care about the dollar terms, but if the Bitcoin to gold ratio can stay stable during that sort of crisis, then I'd say, okay, fine. Bitcoin, I wouldn't say it's money, but I would say it's a viable money derivative. Okay. Because when those things happen, when you have a monetary crisis, it looks like gold's going down, but it's not. Gold always goes up during those crises in terms of other commodities, in terms of stocks, in terms of everything else except for dollars, because dollar is the chief gold derivative, right? But in a financial crisis, if you're real money, you're going to go up, not down. So if I'm not even saying that Bitcoin has to go up in gold terms, I'm saying it just let it stay relatively stable. It did not in 2022, not even close. It went from 37.5 ounces to 10. This time I think it's going to be even worse. But if it's not, not, then, at the end of the crisis, maybe I'll buy some Bitcoin. Because if it's a viable gold derivative, I'm not going to get rid of my gold. I'm not going to sell it, but I'll have some blockchain gold stuff. I don't see that happening, because if you want blockchain gold, there is blockchain gold. Just buy that. Why Bitcoin? I don't get. I could be wrong, but I can't see how it's a viable gold derivative. It might be, and they would have to prove it empirically, even though I can't figure out logically how it would work.
In the interview, Rafi Farber warns of a looming financial crisis caused by extreme short positions in the U.S. Treasury market. Concurrently, Rafi compares the situation to a Ponzi scheme, with firms relying on increasing leverage. He predicts a collapse when the repo market runs out of dollars, forcing the Fed to print large amounts of money. There is no larger thoroughfare for global capital than the U.S. Treasury market, which averages around $900 billion in transactions per day, with high volume days in recent years around $1.5 trillion. There is roughly $4 trillion in repo financing each day. The U.S. Treasury futures market is large and important, with an average daily trading volume of about $750 billion in notional in 2024. In recent weeks, traders have piled into basis swaps, crossing secured and unsecured overnight U.S. dollar rates as anticipated, and existing funding pressures hit repo markets. Based on past trends, Rafi predicts a more aggressive Fed response than in 2020, with faster money printing. He warns that the repo-to-reserve ratio is nearing critical levels, similar to the 2019 crisis. This intervention could lead to a significant weakening of the U.S. dollar. Let's get back to the interview.
I think this is going to be the proximate trigger of the next financial crisis. I could be wrong, but the direction that I see it going in, it's heading in a single direction very, very quickly. What I'm seeing is, for example, if you take a look at the open short positions on the 5-year and the 2-year Treasury notes, they keep getting more and more extreme week by week by week. If you look at the COT reports, the commitment of traders reports, and to open short positions, you need dollars, right? And for dollars, in order to make any money on these trades, you need to multiply them over and over and over again. So you need to borrow a lot of money, a lot of leverage. That's how leverage works, right? The firms that do these trades get leverage through the repo market, and the repo market is running out of dollars. And when it does, you have all these firms, hedge funds, whatever they are, that are opening these trades every day and recycling them with borrowed money. They're also stuck in them. They can't get out, right? They see a winning trade, they keep multiplying it. And then it's like when you start a Ponzi scheme and then the first people need to redeem, you need to go more into getting more clients in order to pay them back. And then you make more money eventually, but you need to keep growing at the same Ponzi principle. So that's what's happening with these basis trades. Like, people on the other side want to close and they have to open more, and it keeps getting bigger and bigger until you're out. Instead of new clients here, you're talking about new dollars, and the new dollars are running out. When they run out, all the trades are going to have to close at the same time, and unless the Fed says, "Oh, here's more dollars." How are they going to do that? They're going to buy bonds like they always do. Since the short positions are so massive, the amount of dollar printing is going to have to be a lot more extreme than it was even in 2020. And it's going to have to be a lot. It might even happen before Trump gets into office. We're at about a 74% ratio of total bank reserves, of repos to total bank reserves. Like, how much of this money is being used for repos? It's about 74%. So last time we had a repocalypse, as it was called, in 2019, the ratio was about 83-85%. So we're almost there. We might not get there by January. We might get there by January, but it's going in one direction. It zigzags up and down. Eventually, it's going to reach it. When it does, the Fed's going to have to print. And when it does, the dollar's going to fall.
The predictions by Jim Rickards and Robert Kiyosaki of gold reaching $27,000 or $15,000 an ounce may seem extreme, but historical precedent, like gold's 15-fold rise in the 1970s, suggests such scenarios are not impossible during crises. Gold's long-standing role as a safe haven and store of value becomes more pronounced in uncertain times. Bitcoin may struggle unless it can demonstrate consistent value retention under stress. Based on the predictions, how do you see the roles of gold and Bitcoin evolving during a potential financial crisis, and what strategies could investors adopt to safeguard their wealth? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.